power of compounding is arguably one of the most important factors that investors can take advantage of. Today, we have with us Wes Crill, researcher at Dimensional Fund Advisors. And Wes, what is all of the hoopla about compounding?
Yeah, it's not quite cold enough in Austin to reach this point yet, but I think about compounding in the same way as building a snowball, right? So you start with something that's little, and then over time it starts to build up through the force of contact. And you can think about just a stream of returns in the way that can grow your wealth. Let's say you start off with $100, and let's say you're getting 5% returns each year. Well, as a function of your original starting capital, then that original $100 would just be growing by $5 per year were it not for compounding. But what that means is after 5 years, instead of growing to, say, $125 with 5 times 5, you actually grow to $127. And that gap, that increase in your overall wealth, it's a function of compounding, really expands as the time horizon expands. And that's an important concept for investors because it means small differences can make a huge impact down the line. And you can think about just the difference between compounding at 9% per year return versus 10%. Well, if I'm investing, say, $10,000 and I have a 30-year investment horizon, that's the difference between growing it out to 133,000 versus 175,000. So the power of compounding is a very important concept for investors.
And that gets back into cost basis, right? What's important for a long-term investor is to buy low, sell high, right?
Yeah, it's like my colleague Joel Hefner always says, that's the key to making money is to buy low and sell high. It sounds so simple. Anyone can do it. You make a good point about the cost basis, which is, some people talk about trying to use dollar cost averaging and should I get into the market at different times. The power of compounding suggests that absent other constraints, you want to deploy that capital as quickly as possible into financial markets and let time work in your favor.
Yeah, because you can actually shoot yourself in the foot, basically, by trying to time the markets and not letting compounding work in your favor and keeping your cost basis low.
It's true. And, it also suggests something that could potentially be a deterrent for your long-term growth of wealth if you had an undue source of volatility in returns, because that power of compounding we talk about in a positive sense, but also works in a negative sense. So if I lose 5% of my portfolio this year, my rate of return is 5% in the next year. On an arithmetic basis, you would think those would net out at zero, but I'm actually still down relative to my starting capital if I had a negative return in 1 year and a positive return the same size the next year. So, again, all of these little details, the costs that go into investing and things of that nature are important aspects that emerge from the concept of compounding.
Yeah, and cost basis, Wes, is what?
So cost basis is, you can think about it as the cost, the entry point when you get into the market. So if the market is continuously going up over time, then the costs of entering the market is going to be increasing over time. But then whenever you get in, the earlier you can get in, the higher your overall growth of wealth will be at some point in time.
So if I buy a share of a fund for like, say, $10, just random number, and it goes up in price to $11. If I sell out and jump back in the market, buy at 11, then when I go to retire or when I need the money, then all I have is the gain from $11 to whatever, versus if I would have sat still and kept my cost basis low at $10, I would have more at the end, correct?
Yeah, it's the opportunity cost of missing out on a period of time where market returns are positive. And unless you know when those periods are going to be, if I could tell you, okay, these are the years when the market is going to be down, then absolutely it would make sense to sell out of the market in anticipation of that and then get back in when that dip was over. We don't believe anyone can predict that on a consistent basis. And the downside potentially is to miss out when the market return is positive and impede your ability to meet your financial goals in the future.
Okay, so maximize the power of compounding.
Exactly.
Okay, thanks, Wes.